Good morning, everyone. Thank you for joining. This is Ashish from Arthasachi Venture. We are excited to launch our new series, Global Markets, Fortnightly coverage. Our focus will be on covering the key markets, equity, commodities, bonds, and currencies. We aim to provide you with valuable insight into the market movements, latest development and event impacting these sectors. We currently cover 21 global markets. In addition to our global market coverage, we bring you in-depth coverage on Indian market. Furthermore, we will dwell into the significant upcoming election from economical and business perspective, the US presidential election, the French legislative election, the UK general election, the first debate between Joe Biden and Donald Trump for the November US election has concluded, setting the stage for a heated race. Let's understand the election significance and its outcome, as Biden and Trump presently vastly different vision for American global role, economic policies, climate change management, and technological development. Global markets are currently following all these three elections. Global investor turned little cautious in the US and the European region last week due to above handover and uncertainty around it. Our esteemed guest, Mr. Narayanan, will join us to discuss the economic and political impact of this election on the global market. Without further ado, let's welcome our esteemed guest, Mr. Narayanan. Last Thursday, US presidential debate between Joe Biden and Donald Trump opened up the race for US president and heightened interest in the November election. How do you anticipate the resulting uncertainty will impact the economy and the policies? Furthermore, what effect do you foresee on both US and the global market? Before you answer, I would like to add another dimension to it, considering the upcoming election in the major economies of the US, UK, and France. How do you expect the prevailing uncertainty to affect the global economy, and what specific impacts do you predict from the political climate in these three economies?
Elections do have a effect on the business. In case if there's a change of the government, and especially in case there's a change of the government where the policies are radically different, so that's when there can be a big effect on the businesses. This year we've seen elections happen in many major economies, starting from Indonesia, then we had it in Mexico recently, then the European Parliament recently, and the mother of all elections in our own country, India. I think one of the world's biggest democratic exercise. And of course, within the next 10 days, we have impending elections in the United Kingdom as well as in France. And then the mother of all elections, which is going to happen in November, the United States elections. So therefore, from a business perspective, everybody will be keenly watching what exactly will be happening. Let me first start with Indonesia. Indonesia, the new government that took over has continued with the policies of the previous government, especially from a business perspective. For example, the previous government had banned export of many of the raw materials and natural resources like bauxite, copper concentrate, nickel concentrate to boost the domestic production. And the new government has followed suit. So therefore, because of the continuity of the business policies, we don't see a major reversal or a major change in the direction of the Indonesian economy. Recently, we also had the Mexican elections where Claudia Sheinbaum, she won, and there's been a bit of a reaction in the markets. Because of the constitutional majority that she has got, there might be some change in the business policies, especially quite a lot of nationalization of the companies can take over. So the markets reacted somewhat negatively. Now, the European Parliament elections, which happened very recently, the rightist parties have taken control of the European Parliament. especially Mary Le Pen of France and Meloni from Italy. So therefore, there'll be a bit of a shift in the policies, especially on the climate change front. The right is far more lenient on the climate change front as compared to the previous incumbents. So one can expect some change in the business policies and decisions, despite the fact that the EU Commissioner has remained the same. Similarly, in India, the ruling BJP government has got lesser number of seats, but the way it has been, we've seen the indications over the last 1 or 2 weeks, with the budget especially coming the next 2 to 3 weeks. There is no expectation that there will be a major reversal in the economic policies of the previous government, especially on the infrastructure front, where the previous government put in a lot of focus. It's expected to continue. So this is reflected in the markets, the stock markets especially going up in India, and quite a lot of positivity around the business scenario in India. So now coming especially to USA, now there's been a lot of reaction to the presidential debate as of yesterday. Now, my personal view is the presidential debate does not necessarily decide the outcome of the elections. It just changes some perception, especially for the fence sitters. One would remember that way back in 2016, Hillary Clinton versus Donald Trump. Hillary Clinton was supposed to have won all the debates, but finally Donald Trump won the elections. So therefore, yesterday's presidential debate was more of perceptions. And the second question was whether the incumbent president, Joe Biden of the Democrats, is really fit enough to run. I think that's a question that's being debated. So therefore, I wouldn't put too much focus on the presidential debate right now. But one thing that has happened is yesterday's debate was supposedly won by Trump. And Trump and the Republicans supposed to be more pro-business. So we saw a bit of jump in the US dollar index from 105.6 to around 106 plus. And the dollar has become stronger. So that shows an indication that if at all Trump comes in, the business interest will be far more enhanced. That's the way the markets have read it, but the stock markets didn't move too high yesterday. One of the things that we need to keep in case of Trump presidency is during the last presidency, Trump actually, one of the major reasons for the Trump government to have a decent economic growth was mainly because of the tax cuts that they did immediately after they took over the government in 2016 or 17. I don't know how much leeway they have in doing the same right now. In fact, the present government has done far better on the economic front as compared to the previous government. So that is number one. And also one would remember Trump is nationalist, and then finally he took a lot of steps to make America great again, MAGA as they call it. He broke the accord which the previous government had signed with Iran, and then he also pulled US out of the Paris Accord also. So Trump's presidency, if at all it comes, is expected to create a lot of volatility in the market. So that is what is bound to happen. But at the same time, Trump wants to make America great again, bring back manufacturing, which will be quite a good boost to the domestic economy. So my view is right now, because of perceptions, maybe if at all there is a Trump presidency, maybe short term the businesses will get a boost, but there's going to be a lot of volatility in the global markets, especially with trade tariff barriers going up, many things happening across the world. In case the Democrats do stay put, I would view that their present economic policy is bound to continue, especially the Inflation Regulation Act, CHIPS Act, focus on infrastructure and all is bound to continue. That's the way I read the market right now. Now, the most interesting election that we all have to watch out for is the French elections. In the recent EU Parliament elections, the party of the President Emmanuel Macron, they lost, and the rightist party of Mary Le Pen, they won in a big way. Because of it, the snap elections was called by the French president. Now, my view is, as I told earlier, the rightist parties, they want to focus more on the country as a whole. That is number one. And the process, from what we've seen recently of the statements made by them, they want to be a little bit more populist. So what can happen is, in case the rightist party win in the French elections also, we can see quite a lot of populist policies taking place, which can put some strain on the finances. So therefore, maybe short term there'll be some business boost, but in the long term, the business sentiments can get soared up. Now, similarly, we see in Italy also, the right-wing party of Meloni is also making a lot of noises, and they also become pretty strong. And recently we've seen, like, the Italian Prime Minister Meloni has strained relationship with the French President Emmanuel Macron and the German President also. So therefore, there is bound to be quite of a lot of churn in in EU especially, and with the EU especially facing a downturn in business sentiments. I think in case if the rightist party wins in France, the downturn in the sentiments in EU is bound to go higher, and it's not good for EU economy as a whole. That's my rating of the market. Now, thirdly and lastly, the British elections, which is there on 4th of July. Now, it's widely expected the Labour Party will take over from the present Conservative government of Rishi Sunak. Now, there's very little to decide from an economic perspective between these two parties. Traditionally, Labour has been socialist, while Conservatives have been pro-business. But right now, if you've seen the last 25 years, looking at the way both the governments have worked, especially the Labour Party have been transformed in the late 90s by Tony Blair. So I think from an economic perspective, I think there's very little to decide to say whether there'll be any major change in the policies in case the Labour Party comes back. So I won't. So that's something which we need to watch out for. So net is what the recent political developments. What I would say is the U.S. elections is to be watched out for. In case the Republicans come back, maybe short term the business sentiments would be high. Long term, on a global trade perspective, we need to watch out for. In France and in EU, France especially, if the rightist party win, that will be a bit of a drag for the economy. While in the British elections, as far as I can see, there won't be any major change at least in the business policies. That's what, as far as I can see. Now, coming to India, is we need to watch out for the budget, the first budget of the new government, which is a coalition government as compared to the majority governments that they had in the past two terms. So that'll be interesting to watch. And as I said earlier, the focus on businesses and focus on infrastructure which the previous government carried on is bound to continue. That's what expectation is. So this is my assessment of the political developments, especially from an elections perspective.
Before we deep dive into individual sections, let's analyze asset performance under different asset classes globally. In the year 2023 has seen diverse performances across different asset classes and regions. US, EU, and Asian equities, particularly the S&P 500, Nifty 50, DAX, and Nikkei 225, have shown significant gains, while European equities present a mixed picture with varying performances. Other assets like Brent crude and gold have also demonstrated strong returns this year, reflecting broader economic trends and investor sentiments. As we move forward, these trends will likely continue to shape investment strategies and market dynamics globally. Let's extend our understanding by little further. U.S. equities. S&P 500. The S&P 500 has shown robust performance, reflecting rich valuation, potential of AI to drive future growth-led stocks, investor positive sentiment in the U.S. economy. With a YTD return of 17%, it has continued its bullish trend driven by AI-driven future growth theme are taking center stage and contributing almost 35% of this index weight by 10 largest stock. So rally was not broad-based, achieving a remarkable 24% growth in the year 2023. This growth is likely driven by AI future growth theme, GDP positive growth rate, and economic resilience despite global uncertainties. Europe equities. The United Kingdom, FTSE. The FTSE index has experienced moderate gains, with a YTD growth of 6% and a 4% increase over the year 2023. This performance suggests cautious optimism among investors, possibly influenced by geopolitical factors and economic recovery post-pandemic. The United Kingdom going through a transition phase, the Labour Party's landslide victory in the general election, which ended 14 years of conservative dominance last week. We will cover more details in our next section. Germany, DAX. Germany's DAX index has performed well, with a 10% increase YTD and a 20% rise over the year 2023. This strong performance reflects the strength of the German economy and its industrial sector, which continues to be a key driver of growth in the region.
France, CAC.
The CAC index has faced challenges, showing a modest gain of 2% YTD but managing a 17% growth over the year 2023. This indicates volatility and investor apprehension, likely due to political challenges, economic challenges, and lack of clear direction. We will analyze the political fallout in our next section. Asian equities. India, Nifty 50. India's the Nifty 50 index has shown excellent performance, with a 12% YTD increase and a substantial 20% growth over the year 2023. India is the fastest-growing economy globally, heading towards double-digit growth under Mr. Narendra Modi NDA government, received a strong mandate in the recently concluded election for his third term. Driver for this are strong economic growth, overall earnings performance, young population, growing middle class, and investor confidence. In a special report we covered why India emerged as the best investment option for the global investor.
Japan, Nikkei 225.
Japan's Nikkei 225 has surged, posting a 22% YTD return and a 28% increase over the past year 2023. This significant growth is likely due to economic stimulus measures, corporate reforms, and a weaker yen boosting export competitiveness. China, Shanghai Composite. The Shanghai Composite has had a challenging year, with a negative YTD growth of 1% and a notable 4% decline over the year 2023. This performance highlights ongoing economic challenges in China, including regulatory crackdowns and slowing economic growth. Other assets. Brent crude. Brent crude has shown solid performance, with a 13% YTD increase and on the back of a negative 10% fall over the year 2023. This growth reflects recovering global demand for oil as economies reopen and production adjustments by major oil producers. Gold. Gold has continued to be a strong performer, with a 16% YTD return and a 13% increase over the year 2023. This performance underscores its status as a safe haven asset, with investors seeking refuge amid economic uncertainties and inflation concerns. The economic and business impact of recent elections in the European Union, the United Kingdom, and France. The recent elections in the European Union, EU, the United Kingdom, UK, and France have brought significant political shifts that are poised to impact the economic and business landscape across Europe. This report explores the outcomes of these elections and their potential implications for the EU's economic stability and business environment.
Good afternoon. I have just returned from Buckingham Palace, where I accepted an invitation from His Majesty the King to form the next government of this great nation.
The United Kingdom elections. The Labour Party's landslide victory in the general election, which ended 14 years of conservative dominance, the United Kingdom's newly elected Prime Minister Keir Starmer has unveiled key members of his ministerial team. On Friday, Starmer appointed Rachel Reeves as Finance Minister, marking the first time a woman has held this position in UK history. The transition occurs amidst ongoing economic uncertainty in the country, with the repercussions of higher inflation still evident and interest rates remaining elevated. The stock markets, along with the property and housing sectors, are expected to be the most affected, while bond and currency markets are likely to experience less impact. The French elections. The French elections have been particularly impactful, with President Emmanuel Macron's centrist party facing significant challenges. The second round of the parliamentary election in France resulted in a hung parliament, with the left-wing New Popular Front unexpectedly winning the most votes but falling short of a majority. Emmanuel Macron's centrist party stood second, offering investors some relief of more radical policies and aggressive fiscal measures being enacted. This has led to concerns about political stability and its impact on the French economy. The European Union elections. The European People's Party, EPP, on Thursday confirmed Ursula von der Leyen as its lead candidate for June's European elections, clearing the path for her second term at the European Commission's helm. "We are the party of the people and we deliver on what people care about," von der Leyen said as she sought the EPP party's support at its Congress in Bucharest. Prosperity, security, democracy. This is what people care about in these difficult times. A new composition of the European Union could lead to changes in EU policies, particularly regarding trade, immigration, and climate change. The recent elections in the EU, UK, and France signal a period of political transition that will have significant economic and business implications. Investors and companies operating in these regions will need to stay informed and adaptable to navigate the evolving political landscape. While there are potential opportunities for growth, particularly in sectors favored by new government policies, businesses must also prepare for increased regulatory and market volatility. In the next section, we will examine its impact on the euro, GBP, and dollar, as well as its effect on bond markets. U.S. market. Wall Street hit record lifetime highs as the S&P 500 and Nasdaq closed at new peaks on Friday. Over the fortnight, the Dow Jones Index, the S&P 500 Index, and the Nasdaq Composite Index gained 0.58%, 1.88%, and 3.75%, respectively, closing at 39,375, 5,567, and 18,352. Year-to-date and in 2023, Wall Street's performance was exceptional. The Dow Jones Index rose by 4% and 14%. The S&P 500 Index increased by 17% and 24%. And the Nasdaq Index surged by 22% and 43%. The Federal Reserve stated it is not prepared to cut rates until there is greater confidence that inflation is moving toward the 2% target. The latest FOMC meeting brought significant disappointment, as economists and analysts had anticipated 3 rate cuts this year, which were reduced to 1, potentially by the year's end. The Federal Reserve officials recognized signs of a slowing U.S. economy and noted a reduction in price pressure, but still counseled a wait-and-see approach before committing to interest rate cuts. The latest FOMC meeting brought significant disappointment, as economists and analysts had anticipated 3 rate cuts this year, which were reduced to 1, potentially by the year's end. Federal Reserve officials recognized signs of a slowing U.S. economy and noted a reduction in price pressures, but still counseled a wait-and-see approach before committing to interest rate cuts. Central Bank leaves rates unchanged in their 7th consecutive FOMC meeting in June 2024. Policy easing depends on more progress in reducing inflation, describes current policy as restrictive. Wall Street's bullish trend has been driven by the AI-driven growth theme, which has taken center stage and accounts for almost 35% of the index weight by the 10 largest stocks, resulting in a rally that was not broad-based. This led to a remarkable 24% growth in 2023, likely propelled by the promise of AI, positive GDP growth, and economic resilience despite global uncertainties. Asia-Pacific markets. The Asia-Pacific markets continue to be a bright spot across all the region. A clear trend has emerged in recent months, with Asian markets decoupling from the U.S. and European markets, where political, economic, and policy risks are high due to the U.S. election, the new UK government, and the French election mandate. Few Asian markets have shown consistent positive gains over the year now, driven by strong fundamentals and better managed economies. The India Nifty 50 Index, the Japan Nikkei Index, and the Singapore STI Index have outperformed their global counterparts. Year-to-date, the Nifty 50, Nikkei, and STI indices have closed with gains of around 12%, 22%, and 5%, respectively. Conversely, Hong Kong and China markets closed this fortnight with continued weak momentum. The Hong Kong HIS Index and the China CSI Index both lost 1.27% this fortnight, closing at 17,799 and 2,949, respectively. On year-to-date, his index gained 4% and CSI index lost 0.84% respectively. The India Nifty 50 index hit a record lifetime high, closing the fortnight with a gain of 3.5% at 24,323. We covered this in a special report, Why India Emerged as the Best Investment Option for Global Investors. The Japan Nikkei index also reached a record high, closing the fortnight with a gain of 6% at 40,912. However, the Japanese stock market's shine diminishes when analyzed in dollar terms, as the yen depreciated by 14% year-to-date. As a result, the real returns for foreign institutional investors are well below those of the Indian market in constant currency terms. European markets. European stock markets are the most impacted on multiple challenges. On one side, 3 elections. European Union, EU, elections, the Labour Party's landslide victory in the general election, which ended 14 years of conservative dominance in the United Kingdom, and the French elections have been particularly impactful, with President Emmanuel Macron's centrist party facing significant challenges due to a hung parliament, with the left-wing New Popular Front unexpectedly winning the most votes, but falling short of a majority. Other side, it's the most impacted region due to the proximity to the geopolitical escalation in Gaza conflict and Russia and Ukraine conflict. Few European markets have shown consistent positive gains over the year now, by keeping their equity market and investor sentiment on the positive frame, although Germany and UK economy are fighting higher inflation. The Germany DAX index, the Italy FTSE MIB index, and the UK FTSE 100 index have outperformed their European counterparts. Year-to-date, the DAX, FTSE MIB, and FTSE 100 indices have closed with gains of around 10%, 12%, and 4%, respectively. On YTD basis, the worst performing markets in the region are the UE FTSE ADX index, which dove 5%, Russia MOEX index, which gained 1%. The France CAC 40 index appreciated only 2% respectively. This indicates volatility and investor apprehension, likely due to political challenges, economic challenges, and lack of clear direction. A special report, Why India Emerged as the Best Investment Option for the Global Investor. Indian equities are expected to lead and potentially remain the best performing market globally. In this report we covered, what makes India the best place to be in for the investor. India is referred to as the mother of all democracy, known for being one of the best-run democracies globally. Last month, it successfully concluded the world's largest democratic election. The NDA government, led by Prime Minister Narendra Modi, has secured a strong mandate for the third consecutive term with a small gain for the opposition party. We will analyze the implications of this political stability on the Indian and the global economy and markets. Strong economic and business relationship with top economies U.S., Russia, Japan, Australia, U.K., European Union covering countries like France, Germany, and Italy, etc. India can play a major role to bring peace between Russia and Ukraine with a strong tie which PM Narendra Modi built with both the superpower United States and Russia based on mutual trust and confidence.
Уважаемый премьер-министр, дорогой друг, еще раз добрый день, очень рад вас видеть.
आदरणीय प्रधानमंत्री जी, परम दोस्त, आपका स्वागत है, हार्दिक स्वागत है। आपको देखने से मुझे बड़ी खुशी है।
Официальные разговоры у нас состоятся завтра,
औपचारिक बातचीत कल होने वाली है,
а сегодня мы можем в такой домашней обстановке спокойно поговорить, наверное, о тех же вопросах, но неофициально.
और आज अनौपचारिक रूप से हम घर के वातावरण में हम
Strong economy best performing corporates. India remains a shining beacon in the fasting growing economy globally. As per IMF projection, India's contribution to the world growth will rise from current 16% to 18% by 2028. India's GDP is estimated to grow by 7.6% in 2023 to 24 as per National Statistical Office. GDP grew by 9.1% in 2021 to 22 and 7.2% in 2022 to 23 respectively. PRI for manufacturing at a 31-month high in May and services at a 13-year high in April-May indicated sustained expansion. Domestic air passenger traffic, e-way bill, toll collections, and diesel consumption exhibited buoyancy in April-May. RBI has taken a bold step to keep the policy repo rate under the LAF unchanged to 6.5% in its MPC meeting on June 6, 2023. India has emerged as a significant economic and geopolitical power. India is heading towards becoming the world's third largest economy in the next 3 to 5 years next to U.S. and China. Digital revolution. India has the world's largest youth population with 356 million people, which accounts for a fourth of the global youth population. India also has a very young population, with half of its 1.36 billion people below the age of 25. The volume of transactions on the digital payment service was 13.89 million in June. Over the year, digital transactions continued to exhibit phenomenal growth of 49% in volumes and 36% in value. A rise was also witnessed in the Aadhaar-enabled payment system transactions, as their volume touched 100 million again after March 2024. Daily volumes of AEPS were higher at 3.33 million compared with 2.91 million in the previous month, with the average transaction size rising to 837 rupees crore daily. Fastest growing stock exchange. NSE is the world's largest derivative exchange for fifth consecutive year and ranks third largest globally in equity segment in calendar year 2023. India overtakes Hong Kong as the world's fourth largest stock exchange. Global investor interest in Indian equity. BlackRock launches ETF on Nifty 50. In June 2024, BlackRock Japan introduced an ETF based on the Nifty 50. This launch marks the fourth new passive fund tracking Nifty indices in the international markets this financial year, with 3 launched in Japan and 1 in South Korea. Rise of the Indian retail investor growing exponentially. There is significant domestic interest in Indian equities due to the country's growth momentum, which is lacking globally. While foreign institutional investors, FIs, remain net sellers in Indian equity markets, most of their selling has been absorbed by domestic institutional investors, DIIs, and retail investors. This trend has persisted for 3 out of the last 4 years, yielding positive outcomes: A. Strengthening the Indian markets, and B. Reducing dependency on FIs. The Indian mutual fund industry's average assets under management, AUM, stood at 58.60 Indian rupees lakh crore, 58.60 trillion Indian rupees. The AUM of the Indian mutual fund industry has grown from 10.11 trillion Indian rupees on May 31, 2014, to 58.91 trillion Indian rupees on May 31, 2024, marking nearly a 6-fold increase in a span of 10 years. The industry's AUM also grew from 25.94 trillion Indian rupees on May 31, 2019, to 58.91 trillion Indian rupees on May 31, 2024, more than doubling in a span of 5 years. Commodities market. Nervousness and volatility have returned to the commodities market. Oil and gold continued their rally this fortnight, maintaining their upward momentum since the beginning of the year. Meanwhile, silver gained 6% this fortnight, achieving a 31% overall gain on a year-to-date basis and closed at $31.53. Natural gas prices experienced significant volatility, with a 13% correction this fortnight and a 7% decline year-to-date, trading well below $2.50 due to reduced energy demand in Europe closed at $2.33. In 2023, natural gas prices dropped by 44%, following 2 years of strong performance. Crude oil. Oil after fourth weekly gain, rising about 3% settles higher last fortnight. WTI crude futures gained by 3.36% to close at $83.44 per barrel on Friday. In the midst of an expectation rebuilding towards a Gaza ceasefire, falling U.S. crude inventories overshadowed robust summer fuel demand and potential supply disruptions from hurricanes in the Gulf of Mexico. The U.S. EIA reported a significant 12.2 million barrel drop in U.S. crude stockpiles last week. WTI crude is anticipated to trade within a range of $76 to $96 throughout this year, barring any exceptional events in the near future. Gold. Gold eased to around $2,364 per ounce on Wednesday morning, continuing its decline from the monthly high and the fortnightly closing of $2,399 on July 5th. In his testimony to Congress, Fed Chair Jerome Powell stated that the U.S. is no longer an overheated economy, with a job market that has cooled from its pandemic-era extremes and in many ways is back where it was before the health crisis. Developments such as the Gaza ceasefire and expectations of easing interest rates also ease some pressure on gold. Gold has appreciated 16% this year, following a 13% rise in 2023. On October 19, 2022, we recommended investors buy gold around the $1,600 level with a price target of $2,800. Similarly, for Indian investors, we recommended buying at 49,125 Indian rupees on September 28, 2022, with a price target of 79,000 Indian rupees through our Global and Indian Markets Daily Report newsletter. Investors are now enjoying around 50% profit in dollar terms and 47% in rupee terms. Let's continue our discussion on commodities with our esteemed guest, Mr. Narayanan, a highly regarded leader in the commodities sector, to gain his perspective on the market. Without further ado, let's welcome our esteemed guest, Mr. Narayanan.
Given the current economic uncertainty due to prolonged conflict in Europe and Middle East, rising inflation, recession in Germany and Japan, and overall geopolitical tension impacting global growth, how should the investor approach investing in gold, both new investor and those already invested in gold? What role does gold play as a safe haven asset in these times, and what advice do you have for the investor? What kind of factors should they consider in terms of risk tolerance and investment horizon?
Before one dwells into the price movements of gold and the outlook for price movements for gold, one should understand what are the key factors that drives the gold prices and gold demand. The demand by the central banks who buy gold to keep it as to diversify their reserves. That is number one. B, institutions use gold as an investment asset. Like as compared to other financial assets. For example, if whenever the interest rates move down, so therefore gold is seen as a investment class as compared to bonds. That is number two. C is of course the retail demand. Retail investors want to keep gold as a part of the portfolio, so as a hedge against inflation. And finally, there is a concept of de-dollarization that's going on. Many central banks also want to keep gold as to diversify away from dollars, as I explained earlier. And also in global trade, many of the trade is moving away from dollar. We recently saw Saudi Arabia coming off the petrodollar deal, and so that they can sell their oil in various other currencies. So therefore, if you look all this put together, there's a good demand for gold. So let us now understand why exactly gold has moved up in the last, let's say, 1 to 2 years. The major reason has been there's been heavy buying by the central banks, especially by China, Turkey, India, Brazil, and Japan. It is estimated that in the last 2 years, the gold purchases by the central banks has been to the tune of 1,000 tons per annum, as compared to 250 to 300 tons per annum earlier. Now, this has been mainly driven by China. Now, China, given its geopolitical issues with the USA, wants to move away from US dollar and promote its own currency, but also as a hedge, they want to keep gold. So therefore, a good amount of gold has been bought by the Chinese bank and also by other central banks. B, retail demand has been pretty strong, especially in China and India. In China, India, because of emotional reasons also. So people, they buy gold as a hedge against inflation. This is number two. Now we all have to keep into consideration that normally gold has got an inverse relationship with the US dollar. When the US dollar is strong, the gold prices is low and vice versa. But in the last 1 to 2 years, we've seen when US dollar has been strong. In fact, the Bloomberg dollar index has been somewhere between 103 to 108. Gold has also remained strong. That is mainly because of two reasons which I explained earlier. So therefore, gold has moved up. Now the outlook for gold from investors' perspective, the gold prices have come off a bit in the last 1 to 2 months, mainly because the Chinese central bank has sort of slowed down its purchases, because of which gold from around 2500 levels has come to 2300 levels as of now. But the central bank purchases are expected to continue because it is seen as a hedge against inflation. So right now we are still in a high inflation scenario. So therefore, central banks will continue to buy gold. This is number one. And B is right now we are looking at a scenario where the global interest rates might start moving down. We have seen ECB cutting its interest rates, and Fed, if not in the next meeting or maybe the subsequent meeting, might look at taking a call on lowering the interest rates. So normally that we've seen that when the interest rates go low, there will be a demand for gold because financial institutions especially might shift their funds from financial assets to gold. So therefore we can see some strength to gold for that. And thirdly, like as I said, gold is seen as hedge against inflation in case of economic stress. We are still seeing quite a lot of geopolitical issues going on. Inflation levels are high. Especially in India, the food inflation is high. So therefore, there will always be a demand for gold. So therefore, I see a strong pricing for gold. There is still some upside left in the pricing of gold. So for investors who have already invested in gold, I would advise them to stay invested. And for investors who have surplus funds to park, so they can park a good quantity, maybe 10 to 15% of their investable surplus in gold.
Thank you, Ram, for covering gold in such great detail. Now let's move to the steel industry. The steel industry is witnessing a recovery post-pandemic, driven by strong infrastructure spending and construction activities in countries like India. In contrast to real estate and infrastructure challenges in China and subdued global growth, what are the key factors currently influencing the steel market, and how can an investor take advantage of this trend while managing potential risk?
The steel industry is in a state of flux because steel industry is predominantly driven by the demand and supply dynamics out of China. Because out of the total 2 billion tons of steel which is produced globally, 1 billion tons is being made in China itself. So therefore, not only steel pricing, but even the raw materials like coking coal and iron ore pricing dynamics are affected by what's going on in China. Now in China, there are two interesting scenarios that's coming out. One is the property and infrastructure sector, which majorly does the demand for steel, is pretty weak. We have seen all kinds of numbers showing that the property and the infrastructure, despite various stimuli that has been given by the Chinese central government, has not picked up. So therefore, demand for steel remains weak. There is some demand pull from the EV sector, but that is not enough to offset the demand loss from the property and infrastructure sector. B, we have seen that the blast furnace operating rates in China is pretty high. At present, as we talk today, it's around 88%, which was about 90% plus about a couple of months back. So therefore, Chinese production of steel is still pretty strong, mainly because of the fact that many of them are state-owned entities, and China wants to keep the production high to keep up its manufacturing GDP. So when production is high, demand is low. So therefore, it's but natural, the exports are pretty high. So China has been exporting in huge quantities with extremely competitive pricing. So markets like India, Vietnam, and other nearby countries, and also EU, have seen quite a lot of steel imports from China. And there's been talk about putting some tariff against Chinese imports. So therefore, that's something that will keep going on. Now coming to India, India saw a very strong steel demand in the last year, about 10% plus, mainly driven by the government's infrastructure push. This particular present quarter has been a bit weak because we are just coming out of the election season and many government funds were not released. But it is expected in the new budget that is going to be presented in mid of July, the infrastructure push is going to continue. So therefore, that will translate to a strong demand for steel. We are entering into the monsoon season. Maybe the next 2 months steel demand might be a bit weak, but subsequently the steel demand is bound to pick up, mainly driven by the infrastructure push by the Indian government. So therefore, my outlook from an investor's perspective is many of these integrated steel producers in India, especially, they can see good times after the next quarter, and which will be reflected in the financials. So the present weakness might go away. So therefore, my main advice for all the investment steel perspective, especially from the Indian companies perspective, is to look at companies with strong fundamentals from an investment purpose.
With the growing demand for electric vehicles and renewable energy infrastructure, how is the copper market expected to evolve given the challenges in the current production capacity and the expectation for future capacity expansion? What investment opportunities and the risk should investor consider when looking at copper as a long-term investment?
Copper markets have been a bit of a sweet spot. Because there's been a huge demand for, mainly because of the EV sector in China. And secondly, there's been a constrained supply, mainly because investment in mines over the last 5 to 6 years has not been able to catch up with the demand. In fact, this has led to a big demand for recycled copper. So this has seen copper prices moving up to almost close to $11,000 compared to around $8,800 a few months back. In fact, the markets have come off a bit, but still then copper fundamentals continue to be extremely strong. The copper demand in the EV sector and the energy transition sector in China, it continues to be in the range of 20% plus. So therefore, and that demand is expected to continue. So therefore, despite the fact we've seen some sell-off in the recent days, I expect copper to remain firm. Now, the risk perspective for copper would be that's been, especially Western nations, especially US and UAE, have been imposing tariffs on Chinese EVs as well as solar panels. So this can lead to some sort of a restriction on production in China. There's been a lot of noises about excess capacity in Chinese in EVs as well as in solar panels and all. So this can be one sort of a drag for the copper demand. But net is my reading of the market is copper demand is expected to be firm. And given the constrained supply chain supply demand scenario, I would expect copper to remain firm, and there's quite a bit of upside left in the market. So investors can look at copper as a big investment habit.
With the recent OPEC decisions to adjust oil production level, how do you foresee the impact on Brent oil prices in the short to medium term? And what strategy should the investor employ to navigate the potential volatility in the oil market?
Oil prices have been hovering between 78, 77, 78 to about a peak of 90, maybe averaging between 82, 83. This I'm talking about Brent crude oil prices. So let's look from a supply perspective. OPEC had announced a cut last year, and then in the last meeting in early part of June of this year, they had announced that some part of the cuts will be unwound off, mainly in the expectation of strong demand. So which led to some sell-off, but again the markets have bounced back. So therefore, that is the OPEC dynamic that's playing up. Russian crude still continues to flow mainly to China and India, so that still continues, even though they've seen some cuts in the production also. That is number 2. And number 3 is US production continues to be strong. That is number 3. Now there are some issues regarding Venezuela and Mexico which we need to see. So therefore, from a supply perspective, things continue to be pretty firm. Now what we need to also consider is there is a spare capacity of 5 to 6 or rather 6 to 7 million barrels per day of oil producing spare capacity available, especially in Middle East, between Saudi Arabia and UAE. So in case of any supply chain shocks, this spare capacity can be utilized to take care of supply chain shocks. Of course, this is given the background that Saudi Arabia needs a price of about $85 to $90 to balance their budget. So that's why they will play their dynamics accordingly. This is the next point. The third point is my personal feeling is the markets have factored in about $8 to $10 per barrel of premium in the present prices. So therefore, you can call it as a war premium, a fair premium, whatever it may be. There's a bit of premium that's been built up into the market. So therefore, despite the skirmishes that we've been seeing of late going up and down in Middle East, so therefore the prices have not shot up too much because there's already premium that's been built into the market, which has been continuing for quite some time. And so therefore, given all this, so therefore from a supply perspective, things look a bit comfortable. So and then OPEC is also, I believe, so it's pretty comfortable at this price around $85. So therefore, there is no major knee-jerk reaction required. So required at this point right now. Now let's look from a demand perspective. At the starting of the year, the demand for oil globally was expected to grow by around 2.2 million barrels per day, which was mainly driven by Chinese demand growth, which was expected to grow at beyond, let's say, 1 million barrels per day. But what we have seen in China is, of course, one is the economic news that comes out of China has not been as what was expected earlier. This is number one. This has been reflected in the oil markets mainly in the weak refinery running rates, both in the state-owned companies as well as in the private refineries and teapot companies in Shandong. So therefore, Chinese oil demand has been sort of lukewarm. Gasoline demand has been weak internationally. Gas oil demand in China has been weak, but ATF demand has been pretty strong, mainly driven by the fact that many people are traveling and flying right now. So therefore, this has reflected in the gross refining margins globally of all the refiners, especially in Asia, coming down. In fact, Singapore GRM right now at present stands at around $3 to $4 per barrel, which is extremely weak. So therefore, given the situation in China and the refining economics, so therefore the oil demand from China is not as what was expected to be. So maybe the demand growth for this year will be slightly less than 1 million barrels per day. Indian demand continues to be strong, mainly driven by the strong economy out here. So therefore, given net all this is a comfortable supply scenario and maybe a slightly less than what was expected demand scenario that's playing out in the global markets. And given the dynamics of OPEC, so therefore my expectation is the prices will remain between 81 to around max of around $90 per barrel. There will be quite a lot of volatility in the market because that's the way the entire oil markets play. So for investors with an appetite for volatility, this can be the market to play and play within a particular range. So that's my advice to investors from the oil market.
Given the current dynamics like inflation, geopolitics, and supply chain issues, are there any specific commodities presenting attractive entry point for investor? Would caution be advised?
As I said earlier, copper markets offer very good proposition as what was explained earlier. Second thing is even zinc markets offer some sort of an update, mainly being even zinc mine supply is a little bit on the lower side. So therefore, from a supply demand perspective, zinc can also offer some sort of an upside, even though the steel markets being low can put a drag on the zinc market. So therefore, there's another product which you can watch out for. And my third product, which is one of my favorites, is natural gas. Because natural gas is a transition fuel from fossil fuels, which is coal and oil, to renewables, and it's got a lower carbon footprint. So therefore, many countries, including India, are looking at increasing the gas consumption within the country. Because it is available in good quantities. That is number one. Supply, there is not major supply issues. B is it's got a lesser carbon footprint, and from a pricing perspective, it remains very competitive. Even today, if you look at JKM or TTF, it remains at around $11 to $12 per MMBTU. So which is very, very competitive as compared to what we see on the oil prices and the coal prices. So therefore, I think that is from a demand perspective as well as from a little bit of a pull perspective. I think still see natural gas as a good market to invest in. Of course, the other major markets is the battery chemicals and metals within the EV space like lithium. Now, lithium has got a good uptake potential. I think that from a long-term perspective, lithium is a good market to be in. This is what I see. And then finally, one of the another metal which I see has got a good amount of upside still left is silver. Silver has got a similar kind of dynamics as gold, but silver has also got an industrial application also. So therefore, for investors who are looking at precious metals as a safe haven, they first went into gold. So gold has rallied quite a lot as compared to silver. You know, silver price have also moved up, but I still see quite a bit of upside in silver markets also. So therefore, investors can look at silver also as an investment horizon.
Global bonds and currencies markets. The past fortnight has been remarkably eventful, marked by significant political developments in the US, UK, EU, and France, as discussed in our earlier section. Additionally, we delved into Fed Chair Jerome Powell's testimony to Congress and the outcomes of the FOMC's last policy meeting, examining its ramifications. Now, let's dive deeper into the economic landscape and analyze its effects on both the bonds and currencies markets. Policy rates across selected advanced economies. Central banks in advanced economies that had positive policy rates before the pandemic, such as the Fed and the central banks of Australia, Canada, and the United Kingdom, reduced these rates to near zero. Central banks that started the pandemic with policy rates already at zero or below, including those in Sweden, ECB, Japan, and Switzerland, head towards reducing policy rates. Conversely, most of the central banks in emerging market economies, EMEs, lowered their policy rates, with India being a notable exception. The Bank of Canada, the ECB, the Swedish Riksbank, and the Swiss National Bank have begun to cut policy rates, highlighting progress toward meeting inflation goals amid sustained softness in economic activity. Policymakers are presenting several arguments against deeper rate cuts. Among EME policymakers, there are fears that more significant reductions could intensify capital outflows. Meanwhile, policymakers in advanced economies are expressing concerns that further rate cuts, especially into negative territory, could damage the financial health of banks and provide little to no additional monetary stimulus. United States. Real gross domestic product, GDP, increased at an annual rate of 1.4% in the first quarter of 2024, according to the third estimate released by the Bureau of Economic Analysis. In the fourth quarter of 2023, real GDP increased 3.4%, but continuing to point to the lowest growth since the contractions in the first half of 2022. Real GDP by industry. GDP by industry, or value added, a measure of an industry's contribution to GDP. Private goods producing industries decreased 1.1%, private services producing industries increased 1.9%, and government increased 2.3%. In the U.S., it appears there is a real possibilities of a soft landing. Inflation has fallen significantly from its peak, and the labor market has gradually cooled but remains strong. The annual inflation rate in the United States was 3.3% for the 12 months ending in May 2024, down from the previous rate of 3.4%. The current annual inflation rate for the same period stands at 3.27%. In comparison, the average inflation rates in recent years were 4.1% in 2023, 8% in 2022, and 4.7% in 2021. Non-farm payrolls exceeded expectations in June. However, significant downward revisions to the April and May payroll counts contributed to mounting evidence of a weakening U.S. labor market. The jobs report also indicated that wage growth decelerated to a 3-year low, and the official unemployment rate unexpectedly increased to 4.1%. Furthermore, previous data revealed that continuing unemployment claims rose for the 9th consecutive week, reaching their highest level since 2021, highlighting the growing challenges in securing new employment. Europe. In the ECB June monetary policy, it cut the interest rate by 0.25 percentage points. After keeping interest rates high for 9 months to check and push down inflation, ECB also highlight that their future decisions will depend on how they see the economy and inflation developing. ECB expects the economy to recover in the coming years. Indicates are there that the economy is started to grow again. Services are doing well. Lower inflation and higher wages means that people can spend more. More demand from the rest of the world should also support economy. Wages are still rising strongly. Higher wages are helping workers make up for past rises in prices. Firms are still looking for new workers, though less so than in the past. Unemployment is the lowest it has been in 25 years. ECB GDP projections for Euro area's economic growth is 2024 is 0.9%, and the coming year are 1.4% for 2025 and 1.6% for 2026. Inflation. ECB expect inflation to fall to their 2% target in the second half of 2025. Its projections for Euro area inflation in 2024 is 2.5%, and the coming year's projections are 2.2% for 2025 and 1.9% for 2026. Preliminary figures showed that the annual inflation rate in the Euro area decreased to 2.5% in June, although the core rate held steady at 2.9%, and inflation in the services sector remained high at 4.1%. Economists and analyst community had been expecting the ECB once or twice rate cuts this year. However, policymakers remain tight-lipped as inflation is still not under control, and political changes in France and the composition of the EU have raised concerns. Bonds market. U.S. Treasury's 10-year bond yield fell below the 4.3% mark, continuing its steep decline from the one-month peak of 4.47% reached on July 1, 2024. It gained 41 basis points on year-to-date and closed at 4.2480. The upcoming FOMC meetings are being closely scrutinized to ascertain whether there will be an earlier-than-expected adjustment in the Federal Reserve's policy to lower interest rates before the year's end. Similarly, Germany, UK, and Japan Treasury's bond yield gained 53 basis points, 64 basis points, and 45 basis points respectively on year-to-date and closed at 2.5490, 4.1760, and 1.0610 respectively. On the other hand, India's remained the only market where bonds yield fell 17 basis points on year-to-date and closed at 6.9980. You can get more details about Indian market in our special coverage. Let's glance through these market for the last 3 years. US, Germany, and UK Treasury's 10-year bond yield dropped 1 basis points, 53 basis points, and 12 basis points respectively in the year 2023 and gained 236 basis points, 275 basis points, and 270 basis points respectively in the year 2022. On the other hand, India's remained the only market where the impact was minimum due to global economic fallout. Indian 10-year bond yield just dropped 12 basis points in the year 2023 and gained 87 basis points in the year 2022. Currencies market. The strength of the US dollar is evident against major currencies such as the Japanese yen, Singapore dollar, and Chinese yuan, CNY, which have depreciated by 14%, 2.72%, and 2.4% respectively, year-to-date. In contrast, the most resilient currencies against the US dollar have been the Indian rupee and the Australian dollar, with depreciations of only 0.46% and 0.9%, respectively. The Indian rupee showed similar performance in 2023, depreciating just 0.46% against the US dollar. This trend can be attributed to the robustness of the Indian economy. Now, let's delve into a special report, Why the Japanese Yen is Falling Year After Year Against Major Currencies. Special report, Why Japanese Yen is Falling in the Last Few Years Against Major Currencies. The Japanese yen fell to 161.5 per dollar, its lowest value in 38 years. Yen depreciated 14% on YTD, 8% in 2023, 14% in 2022, and 12% in 2021 respectively against US dollar. We believe 4 factors contribute to this decline. Firstly, economic factors. Japan's economy contracted at an annualized rate of 2.9% in the January-March quarter, according to a revised report. This decline is steeper than the previous estimate of 1.8%, partly due to lower public works spending. Secondly, Bank of Japan support and intervention. The Bank of Japan's reluctance to adjust its monetary policies also contributes to the yen's depreciation. There is increasing speculation that the BOJ may raise rates at its policy meeting in late July. Thirdly, government support. Finance Minister Shinichi Suzuki highlighted that the government remains vigilant to currency moves, stating that foreign exchange levels reflect a complex mix of factors. Lastly, interest rate differences. Significant interest rate differences between Japan and the U.S. bond yields might also be weighing on the yen's decline. A special report, Why India Emerged as the Best Investment Option for the Global Investor. India is not only the fastest-growing economy globally, but it is also poised to transform the composition of the world's bond market. This report explores how this change will occur and what it means for India. Future of India's government bond market. As per World Bank, starting in June 2024, Indian government bonds will gradually climb the index ladder, reaching a 10% share of the JP Morgan index by March 2025. For the Bloomberg index, a similar process will start in January 2025 and go on until October 2025. What does this mean for India? If India is to realize its dream of becoming a developed economy by 2047, the centenary of independence, it will need to attract private capital to stay competitive and provide a high standard of living to its people. Until now, however, the availability of private capital at the right price has been one of the challenges. India's banking sector and other financial institutions, rated among the best globally, have shouldered this responsibility. However, higher domestic interest rates compared to global rates are making borrowing more expensive. Now that more of government bonds can be bought by foreign investors, a larger share of domestic financial resources will be available for investment in avenues beyond government securities, GSECs. Over the next 5 years, experts predict an annual wave of foreign investment of $30 to $40 billion, freeing up an equivalent amount of domestic capital for investment by the private sector. For foreign institutional investors, FIs, India remains an attractive investment market due to its high growth rate and heading towards becoming the world's third largest economy. Consequently, their interest in India's bond market is obvious. Reactions to the move have been positive. India joining the JP Morgan EM Bond Index is more than a milestone. It's a green light for global investors to take a keen interest in India, said Lakshmi Iyer, CEO, Investment and Strategy, Kotak Alternate Asset Managers Limited, who works at the front line of this transformation.